We're giving the report back on the Northstar Global Flexible Fund in dollars for Q1 2024. Let's just start with the purpose of the fund. Our aim is to outperform our peer group, the flexible sector, global flexible sector in dollars. And then of course we also have the second objective, which is to outperform large cap equity funds. How's the performance been on the fund? Well, since inception, the fund has outperformed its sector quite considerably, and in fact is in the top 7% of funds. Over every other normal conventional reporting period, the fund operates in the top third of managers within its sector, mostly in many instances in the top 10 and 20% of its peer group. And it's outperformed its peer group over every conventional period. Just in terms of our own positioning at the moment, we've been net sellers of equities. Our buy lists show poor prospective returns globally, just in terms of the way the market has moved up aggressively over the last year and a bit. We overweight defensives, most notably healthcare and staples, and we've become underweight cyclicals and in particular technology. On the fixed income side of the fund, we were buyers of fixed income late last year when bond yields sold off in the US up to 5%. And then we saw a big rally and we were net sellers, right down to 4% yields. Subsequently, in the last few months, as interest rate expectations have changed, yields have again started to move out and we're buying fixed income investments. The opportunities in the fund. Well, we have a long history of delivering alpha, and our greatest opportunity, quite frankly, is the stocks we own, which we think will outperform the market. But the next bit is just our own flexibility and the infrastructure we've built over time that allows us to quickly capitalize on opportunities in the market. What worries us? Our largest concerns? Well, first and foremost, market complacency. We think there are opportunities and threats in that. The way the fund's positioned, any big sellout in the market will allow us to buy back risk assets. Then there's geopolitical risk that we don't believe is priced into asset classes in certain instances offshore. And then last and most important for us is the low risk that the Fed will actually deliver an immaculate landing. They're either going to hold rates too high and crush growth, or they're going to cut rates too soon and ignite inflation. It's going to be very hard to manufacture the perfect landing for that economy.